Our next guest wants to ruin all our great stock stories. A man of fear approaches. Robert Prechter is president of Elliott Wave International. Robert, good evening to you. The greatest shorting opportunity for a generation.
Well, it's the third best. I think the best was in 2000. The next one was 07. If you're in real estate, it was 05. And now we're getting a third opportunity in 10 years with everything lined up on one side of the ledger.
What would you short exactly?
Well, I think the main thing I'd like to say, most people are not short sellers who listen to financial television. Most of them are mutual fund owners, and they've got their 401ks. I think the main message I would like to say is there's no reason from a technical point of view to be invested in stocks right now. There's every reason to be in cash. It's not a scary thing to do. You can wait for a better buying opportunity down the road, and it's going to be way down the road.
Where is that level, Robert?
It's going to be a lot lower because what we have today is we have mutual fund cash at 3.5%. That was after February. Forget bringing March into the picture where there was nothing but buying. We're going to see an all-time record low mutual fund cash percentage in the next report. That's even lower than October of 07.
Can you give me a target, though? I mean, any kind of target. 10%, 20%, 50%. I mean, saying it's going lower doesn't help me.
It does help you because what it says is you want to be in cash until all these indicators line up on the buy side, just as they were in March 09. Now, I was on CNBC in early March of 09 saying this is a bottom. We were projecting 10,000 on the Dow. It's gone to 11,000, but that's not extra bullish that it's gone further. It simply stretched the market to a further extreme.
Sure, but that's a good target. Just give us a target. Don't just say down.
But how extreme was the market on the way down? I have to help Robert out a little bit of this. I mean, first of all, I agree with you on the exhaustion points. We follow a lot of technical indicators, DeMarks, some of the Elliott Wave stuff. I mean, whatever you're looking at, markets, and I said yesterday, we were selling U.S. steel. We were selling some of the commodity names, some of the coal names, not because I think the global economy is coming to an end. In fact, I think the opposite. I think these things are overdone. However, if you look at what happened on the way down, the move in the exhaustion points and the oversold conditions on the way down were so extraordinary. Why can't we have this on the way back out, Robert? I mean, it just seems to me it's the other side of the coin.
We're extremely overbought with a percentage rise in just 13 months. Not only that, but we're losing upside momentum. We've got a 30-day trading index reading of 0.90. That is extremely low for a 30-day period.
Robert,
June of 2007.
The S&P right now is trading on forward earnings 14 times. The 18-year average is 16 times. In 1999, we're trading at 25 times. We still have a lot of room to the upside. You're discounting cash balance sheets at this point.
No, the valuation in the market is terrible. The dividend yield is 2.5%. There have only been two other tops in the last 100 years when dividend yield was that low. It was 2000 and 2007.
I hear you, but corporations had to hold cash. Of course the dividend yield's low. The question is, I think what Steve's saying is actually cash on the balance sheet's never been higher. And in fact, why wouldn't they be paying out? These are corporations that are not in trouble. They're actually cheap on a price to cash flow.
Portfolio managers, Robert, portfolio managers look at forward earnings at this point. So trading at 14 times forward earnings based on 16 times.
Let the man reply. Let the man have one last word, sir. Robert.
Sold.
People always look at forward earnings, and then when they were looking at forward earnings in March of 2009, they were scared out of their wits because they knew forward earnings were crashing. Now they look wonderful. Which environment do you want to be long? Do you want to be long in March 09, or do you want to be long in April 2010?
What I'd rather be long is equities, because the rest of the field doesn't look great right now. Bonds look terrible. Everything else looks bad. So right now in the bucket, equities are your best chance.
Mr. Prechter, thank you very much for your time. Thank you for joining us on Fast Money.
What looks good is cash.
Bottom line it for me, Joe.
The bottom line is we would need a fundamental catalyst to take us down.
How about this? The bottom line is he's worried about inflation. Cash is going to get devoured by inflation. Sorry to interrupt. Go ahead.
Thank you. You need a fundamental catalyst to take you down into an Armageddon type of scenario. Right now, the market over the last 6 weeks has digested all the events that possibly could be the fundamental catalyst. So that's why you have to call into question a deep dive.
Can I just make one point, though?
Sure.
That we have pumped so much in to get everything to where it is now. If there was, God forbid, a big exogenous negative shock, we tip back, and we don't have much firepower.
See any stoppage of the pumping? Because I don't see any right now.
No, but if you haven't
doesn't last forever. We're just saying his timing. He's calling it out in May. So to call out a fall off the cliff in May, that's ridiculous.
And my point was simply, if you can't give me a target, I'm not saying you're going to be right about your target, but in 2 months is he going to come back on the show and say, see, I told you the market was down 50 points the day after I said it?
I told you that in March of 09 it looked good, which is pretty easy to say.
We have to leave it there, gentlemen. Thank you very much. We need to take a break. After that, why you might be wanting to buy Microsoft ahead of the technology earnings, and equally short Walmart. Stay with us. More Fast Money coming up.